On April 2, 2025, President Trump sent shockwaves through the global economy. He announced sweeping new tariffs on imports from all U.S. trading partners. The move marked a significant escalation of his protectionist trade policies. The president claimed the tariffs were necessary to protect American jobs and reduce the trade deficit. However, the decision was met with immediate condemnation from business leaders and economists. Many warned of a potential trade war and its devastating consequences for the global economy. The tariffs, set to take effect on April 5, were structured in two tiers. A blanket 10% tariff would be applied to all imports. On top of this, an additional set of tariffs, ranging from 5% to 25%, would target specific countries. These targeted tariffs were seemingly designed to punish countries with whom the U.S. had a significant trade deficit. The Trump administration argued that these tariffs would force trading partners to the negotiating table. They believed this would lead to more favorable trade deals for the United States. However, the announcement sent a chill down the spines of investors and businesses worldwide. The tariffs represented a dramatic shift in U.S. trade policy, one that threatened to upend decades of global trade norms. The move had the potential to trigger retaliatory tariffs from other countries. This could quickly escalate into a full-blown trade war with devastating consequences for all involved. The response from the international community was swift and decisive. China, the primary target of Trump's tariffs, wasted no time in announcing retaliatory measures. Within hours of the U.S. announcement, China slapped tariffs of 34% on a wide range of American goods. This included agricultural products, automobiles, and chemicals, sectors crucial to the U.S. economy. The European Union, Canada, and Mexico also vowed to retaliate with tariffs of their own. The escalating trade tensions sent shockwaves through global supply chains. Businesses were left scrambling to adjust to the new reality of higher tariffs. The International Monetary Fund issued a stark warning. They stated that the tariffs could shave off as much as 0.5% from global economic growth. The organization urged all parties to engage in dialogue and find a peaceful resolution to the trade dispute. The stock market, a barometer of investor confidence, reacted with predictable alarm. The Dow Jones Industrial Average, a key indicator of the health of the U.S. stock market, plunged by over 3,900 points in the 2 days following the announcement. This was an unprecedented drop, wiping out trillions of dollars in market value. The tech-heavy Nasdaq Composite, already reeling from a series of setbacks, entered bear market territory, signaling a prolonged period of decline. The sell-off was fueled by a potent cocktail of fear and uncertainty. Investors were spooked by the prospect of a protracted trade war and its potential impact on corporate profits. The uncertainty surrounding the tariffs made it difficult for businesses to plan for the future. This led to a freeze in investment and hiring, further darkening the economic outlook. The Federal Reserve, tasked with maintaining the stability of the U.S. financial system, found itself in a precarious position. The escalating trade war threatened to derail the economic expansion. This left the central bank with limited options to cushion the blow. Federal Reserve Chair Jerome Powell, in a carefully worded statement, acknowledged the potential negative impact of the tariffs on economic growth and inflation. However, he stopped short of announcing any immediate policy changes. This left markets on edge, unsure of how the central bank would respond to the unfolding crisis. Economists were quick to criticize the tariffs, arguing that they were ill-conceived and counterproductive. They pointed out that tariffs are essentially a tax on consumers. They argued that the tariffs would lead to higher prices for imported goods, hurting American consumers and businesses. Moreover, they argued that the tariffs were unlikely to achieve their stated goal of reducing the trade deficit. Instead, they predicted that the tariffs would likely lead to retaliatory measures from other countries. This would harm American exporters and further damage the global economy. As the dust settled on the initial shock of the tariff announcement, one thing was clear. The global economy had entered a period of heightened uncertainty. The outcome of the trade war remained highly unpredictable. However, one thing was certain: there would be no winners in this self-inflicted economic conflict.